Look at this world. A force of nature, a financial panic, a health crisis, disasters strike in countless forms. We mourn the victims, we rally aid, we try to rebuild. But what if you could profit from the very suffering and instability that plagues humanity? What if the greatest winners weren't the heroes of recovery, but the unseen players, the ones betting against the future itself? This is the dark, unsettling truth explored in this film. The story of how certain billionaires, through sophisticated financial tools, managed not only to survive the crises they helped create, but often profited from them. It's a paradox that sits at the uncomfortable intersection of wealth, greed, and the fragility of our shared world. A story that demands our attention. This isn't a single story, but a pattern that emerged, most starkly in the early 21st century. It's rooted in the complex, sometimes arcane world of finance, built on intricate layers of debt and risk. But you don't need a PhD in economics to grasp the basic mechanics. It's about betting against systems designed to protect us, and being rewarded handsomely when they fail. It's a bet placed not on sunshine and prosperity, but on disaster and decline. Think of it like this. Imagine a complex machine, like a massive sewage system, show animation of pipes. Money flows through it, lent out by banks, the lenders, to borrowers, show animation of houses, businesses, governments. But what if the borrowers are shaky? What if their payments are unreliable? This is where the key players enter. The lenders, needing protection against their risky loans, bought insurance. But instead of traditional insurance, they used complex financial products called credit default swaps, or CDS. These weren't just bets. They were contracts promising a payout if the borrower failed. And crucially, the seller of these CDS, the one taking the risk, wasn't necessarily regulated or even identified by the buyer. This seller could be a giant hedge fund, a billionaire-backed entity, or even parts of the very banks that lent the money. They were selling insurance without having the actual loan in their portfolio. It was like selling flood insurance for a city's levees, but not actually building or maintaining them. The more of these CDS policies sold, the greater the total risk concentrated, like stacking hay bales in a dry field. The perfect storm came in 2008. The housing bubble burst. Millions of homeowners couldn't pay their mortgages. The banks and financial institutions that had packaged these risky home loans into complex securities, collateralized debt obligations, CDOs, were on the verge of collapse. This wasn't just bad business. It was catastrophic for the global economy. The lenders were drowning. Their complex investments were backed by troubled debt. But the sellers of the insurance, the ones who had bet against the stability of that debt, were the ones who reaped the rewards. Every dollar the lenders lost because homeowners defaulted was potentially a profit for the CDS sellers. It was a perverse windfall. Warren Buffett, the renowned investor, famously bet against the U.S. housing market in 2007, a bet that made his firm, Berkshire Hathaway, billions just as the crisis unfolded. Similar strategies were employed by others, some even more opaque. The consequences were devastating. Billions were wiped off global GDP. Millions lost their homes and savings. Governments intervened with unprecedented bailouts, propping up the very financial institutions that had caused the meltdown. The moral outrage was palpable. Yet, the system that allowed this wasn't dismantled. It was, in many ways, refined. Similar instruments, sometimes disguised, still exist today. Did this crisis change things? The 2008 collapse forced a global reckoning. Regulations changed, at least on paper. But the fundamental structure remained. Complex financial products bundling risk, and sophisticated actors betting against systemic stability. We saw echoes of this mindset during the COVID-19 pandemic. While many lost value, some investors saw opportunities in volatility, betting on the disruption caused by lockdowns and economic shutdowns. And the climate crisis presents a new, existential frontier where similar dynamics could play out, betting against the transition to a sustainable future, profiting from the instability it creates. So what is the lesson? It's not that billionaires are inherently malicious. It's that the financial system can, through complexity and flawed incentives, reward those who anticipate and bet against collective well-being. It highlights a dangerous disconnect, the immense power and privilege of the few and their ability to profit from the pain of the many. It forces us to ask, how much risk should we allow the wealthy to bear? And who truly bears the cost when the bets go wrong? The story of those who bet against humanity isn't over. It continues to unfold in our markets, our climate, and the very fabric of society. It's a stark reminder of the high-stakes game we're all playing and the uncomfortable questions it raises about wealth, responsibility, and the future we're building together. The moral paradox remains: profit from disaster or protect against it? Which side will you stand on? What does this story reveal about the ethics of our financial system today? Do you think the system itself encourages this kind of inverse betting? Let us know your thoughts in the comments below. Like this video if you found it thought-provoking. Thanks for watching. Stay informed.